Okay, welcome back. Lesson 16 now. Going to be talking about A.B.C.D formations and the market types. A.B.C.D formations is the way the market trends. You can clearly see when it trends. It moves in waves, creating higher highs and higher lows in a long market, and then lower lows and lower highs in a short market. Why does this happen? When the market expands, there is too much pressure to keep continuing on, so it needs to contract to relieve the pressure. So the price usually retraces to a Fibonacci level before continuing on in its relevant direction. Another context for this would be the buyers believe that the price is currently overvalued, so they stop buying. Short-term sellers try to pick the tops and start selling, which makes the market retrace momentarily. When the price is more favourable, the short sellers take their profits and the buyers enter at a cheaper price, creating the market to continue onwards in its relevant direction. And because it's with the trend, there will be more buyers than sellers at this point, which makes the market trend. Here is a prime example of the formations in the market on the two pictures I've got following below. Now, as we can see in the picture, you'll need to go on the website and probably have a look at these pictures in a little bit more detail, but they're on the page. Have a little zoom into them, inspect them. But as we can see in the picture, there's a long market in play here. It's making higher highs and higher lows. You can clearly see the tops and the bottoms of the moves once you draw the lines. The rule of thumb here is to buy on a reversal at the C level, which you should have a candlestick formation and a bounce from either sort of support level, whether it be a moving average, trend line, support and resistance level, or Fibonacci level. You can see in the picture when the market has made its formation, it all starts again. The last C becomes the new A of the next move, and it continues on until the market breaks below the last C formation. Once that has happened, this usually tells you that the trend is changing, but it's not always the rule. You have to take the bigger picture into perspective. Small trends get smashed all the time. That's where we talk about this picture here. Like in this picture, it's the same move as the one above, but it has smaller A.B.C.D formations built into the bigger formations. Smaller trends and counter trends getting smashed all the time. So when you're trading, always trade in the direction of the trend on a higher time frame and wait for your opportune entry price. Okay, so you can't always base your trades on these small intermittent moves. You'll be getting chopped about. If you're trying to buy too near the top, you're going to get stopped out. So wait for a nice little reversal down. Wait till it's made a few moves downward before you start re-entering. Always taking the bigger picture into perspective. Okay, so the A is always the beginning of the move. The B is the first high, which will be confirming the trend direction based on breaking the last high. This will make the higher high. You then wait for a retracement to a support level, which will be your C, often defined by a candlestick formation. And the D formation will be your unknown profit target level. There are a couple of profit target requirements here. So the D formation is always a D extension of the move. So usually the move does actually continue on past the B, but there's a lot of likely scenarios where the D formation might actually make a double top with a B and then retrace, or it might only extend 5-10 pips beyond. So we can't always expect the market to continue on and on and on before making a retracement and correcting itself. So there is a few things we've got here that you can use for your take profit rules. Number one is take profit at the level of the last B. So the last high that I made, you should be using this for your analysis to make sure that your profit targets are within your criteria for your money management. Making sure that it's around a 2 to 1 risk to reward ratio. So that's usually where you could place a take profit level. If it was for the full amount or even a part of the trade, and continue on with the other half of the trade with a manual trailing stop. But I like to take the full position out all at one time. Another one would be take profit on a Fibonacci extension level. So this would be a 120% extension or 168% extension, whatever your trading style. You should have a little look into Fibonacci's and their extension levels. Just much like the retracements, they're a good self-fulfilling prophecy, which means there's so many traders that actually use them in day-to-day trading that many of them actually place their profit targets there or just before it, and you'll see the market tends to reverse a lot of the time on these levels just because there's so many traders that actually use these as exit levels. Okay, and number 3 would be leave the profit target open and use a manual trailing stop. Trailing your stop loss below the lows of the move. Okay, so you would move your stop up every time it made a new high. You would move your stop up to the last move, makes a new high, move your stop to the bottom of the last move. Okay, so that's a manual trailing stop. These patterns occur on every single time frame, from 5 minutes to monthly charts. They're all the same. The longer the term, the more stable they are, and I wouldn't recommend using this strategy below an hourly chart, as there is too much noise in smaller time frames. This also makes smaller formations inside larger formations, inside even larger ones. That's how the market moves. You need to become familiar with that movement. When you get a move in your direction after making a new high, protect your position by moving your stop loss and expect a pullback. Okay, this is the nature of the market movement. Market types, we're going to talk a little bit on charts, but the market types are as following: fast trending, whether it's long or short; slow trending, same again, long or short; and ranging markets, sideways markets. Trended markets are easy. Just stick with the trend, cut out counter trades, so in other words, don't sell when it's a long market. Rule of thumb: buy low, sell high, let your profits run. Range markets, as discussed earlier, have different rules. Buy at the bottom of the range and sell at the top of the range. Take profits at the top and the bottom of the range as well. Trade on the breakout and watch out for change of polarity on the support or resistance levels defined by the range. I'm sure we covered that in a previous video, so I won't go through the change of polarity and ranges, but we'll jump over to the charts just now and just have a look at a few market types here. Okay, so we were just talking about ranges there. So I've got the Aussie US dollar chart here, and the great thing about Bollinger Bands, like I've said before, is they can clearly define that you're in a range market, because they've completely contracted and they really can't get any smaller than this. They're defined by very, very level tops and bottoms, and you can see that it's clearly in a range here, defined by a little double top here. Some of them never quite made it, but move it down a little bit after this one. You can see here, you can see here, so that's the true top of the range right there. Bottom of the range defined by these candles here. nice little spike off there. There's plenty of buy and selling opportunities in here, and then this is the breakout of the range, and you know you're definitely in a short market after that. And usually what happens after the range market is it will usually burst out and just continue on this direction after the range. And the rule of thumb is usually about the length of the range. It would be the length of the move afterwards. It's not always the case though, but it's something to think about. Let's just see how far that went after. So you can see this went down quite a considerable distance, roughly about the same length as this, just taking it as a visual perspective. Okay, so Bollinger Bands are great for spotting range markets, but get into a habit of drawing your support and resistance levels in, looking for your A.B.C.D formations, drawing in your trend lines. But the most important part is this putting in your support and resistance lines, because your A.B.C.D formations are defined by these levels as well. Okay, so let's just say this is one big move. Just going to explain something to you very clearly. So if this was a move, this was the A right here, this was the B, okay, defined by the low and then the new high. Okay, so A, B, and then the bottom of the range is the C. Now we're actually waiting for a D extension at this point, so most traders would have actually bought on here, because I bet you if you put a Fibonacci level in, yes, you had an area of 38.2% now, so you'll be getting a lot of traders buying in at this level. I'm sure you can find more support and resistance level back in history a little bit, but let's just say you've had your A, you've had your B, you've found a possible C area, so you're laying on a buy. Yes, the price went up a little bit, and just what I was talking about before, that the price can make a double top, might not necessarily reach to the 1.27 extension or the 1.68. It can just reach the top, make a double top and reverse. Might continue on for 5-10 pips. And funny, I was just talking about that because I didn't even think about this, but that's what happens sometimes. But anyway, retrack a little bit. You've got your A, you've got your B, you've got your C. Right, the price can move in between these two levels as much as it wants. Okay, it can go on for a year if it really wants to. Right, but your trend is defined by the point of where it breaks out of either the C or the B. Okay, if it breaks the B, you know you're still on a long trend and it's all good. If it breaks below the C level, then you know something's changed. You know the A.B.C.D formations have been broken. Okay, very important note to just to write that one down, that the price can continue on in between the B and the C for as long as it wants. Okay, little tip for you. Move on to different markets. So we've got we'll go into this one, just try and find some trending markets. You can see we've got a trending market here. Might not be the prettiest trend market you've seen in your life, but it's definitely trending. It's making higher highs, higher lows, keeps breaking up. A.B.C.D formations in place here. Keeps making highs, keeps pushing through. Tricky the market to buy in though, because it is pretty choppy. It's not very smooth and looks pretty volatile. But it's not a fast trending market. It's definitely a slow trending market. Take a long time. You'll be moving sideways for many hours. We'll just have a look at this little area here. That's 104 bars, and this is a 1 hour bar chart. So yeah, you're going to be caught up in there for days and days, really bored, price not going nowhere, then it comes down, then it goes up, then it comes down again. Bit of a headache. Not the prettiest market, try to stay out of that. So moving on, but markets go through a cyclical nature, which means they'll be going from nasty, choppy markets, and they'll start trending out, they'll start smoothing, and it's those ones that we want to look out for, we want to capture. You can see, we've got nice moves there, but it was only short term. Moving on, yeah, it's still a bit nasty. You can see the trend starting to level out a little bit, but it's still overall it's just a bit choppy sometimes. Nice downtrend. You can see if we put in a 100 average there. Let's mark that white. So we can see in the slow trending markets, if you've got a 100 moving average in, what will happen is the price will usually either touch the 100 moving average, and in some cases the price moves beyond the 100 moving average just ever so slightly before continuing on. When you start getting a fast trending market, although it's still coming up, it'll touch it a few times, but when it starts speeding up, so over this period of time we're getting retracements, but they're not coming up anywhere near the 100 moving average. This is a short term fast trending market. Let's see if we can find some more, because I know, okay, maybe the euro's been a bit choppy. So Euro Japanese yen chart. So now we've definitely got a fast trending market. That's the 100 moving average there, defined by the white line, and I got a 200 moving average defined by the blue line there. As I was saying before, the price comes nowhere near the 100, keeps making higher highs, higher lows, but the retracement of the low doesn't come near the 100. It's probably bouncing off the 50 a little bit. So the market does change through these little stages. If you find yourself in a fast trending market, that's a perfect time to be using a manual trailing stop. But if you know you're in one of these kind of choppy markets right here, you want to be taking your profits out fairly quickly. So if you get to your 2-to-1 reward ratio, or you get to 2.5, just take the trade out, because sooner or later the price is going to come back down and you're going to have another entry point somewhere. So keep an eye on the moving averages. They're a good definition of the momentum of the market, although I don't really like to trade off them that much. I'll trade off bounces and candlestick formations from them, yeah, but I don't trade on crosses and trading systems like that, because they tend to be lagging indicators. So, but I do use moving averages all the time, because it does give me a good direction on what the market's actually doing, whether it's choppy, and look at the angle of them. If they're pointing up a nice 40 degree, 45 degree angles like that, you know you're in that fast trending market. And you can, even when we're at the beginning of a move, you can see it started creeping up, getting steep. You just know that you're in a fast trending market now. So, and also the distance between the 100 and 200 started expanding like that. Of course, a reversal is imminent. You can start to see that it's slowing down a little bit, might be losing a little bit of steam, and then what do you know, everything starts to change again. Again, it's still a nice slow trending down the way. You can see the market going down, coming up, touching the 100, going down, coming back up, touching the 100, so forth, so forth. Okay, so use your moving average for a little indication. When you see chopping and changing, moving averages are flat. They move from one side of the screen to the other pretty much on the same level. It's not nice trading in these markets. You're going to be in and out, winning, losing, all over the place, okay? So just wait for the nice setups. You might be a little late on some entries, but when you know you're in one of these trends, definitely capitalise on it. And yes, stick with the trend. Don't believe that you've hit a true bottom or a true top, whatever it may be. The market can always continue on. It can always go to zero, it can always go to infinity. So always stick with the trend, don't do your counter trades. I know it's going to be very, very tempting when you see engulfing bullish candles in a bear trend. You think you would caught the very end of a reversal, or the beginning of a reversal, sorry. But 90% of the time it's not always the case. It's a good way to lose your account balance trying to pick tops and pick bottoms. Okay, so always looking out for the nice smooth action of the moving averages. You can tell the difference. Look, nice smooth as opposed to the choppy nature. Okay, so I think we'll leave that for now. There may be more videos on certain market types and advanced trading techniques which you should have access to. More about Fibonacci's and more about A.B.C.D formations. But for now, I hope you enjoyed the video, and I think we've got one more on the basics of Forex. And thanks for watching this one. See you on the next one.